My name is Tyler Braun. I'm the Director of Financial Planning with the Tranel Financial Group. I want to talk about investment strategies, and more specifically, one of the most underutilized investment strategies out there. Right? It's called dollar cost averaging. Right? You might see the acronym DCA, and that's dollar cost averaging. That's what it stands for. And a lot of times when we hear that term, people have heard of it before, but they don't fully understand how it works. So by definition, dollar cost averaging is just adding money periodically. So let's say, for example, you're working for an employer and you're adding to your 401k. So every pay period, or every 2 weeks in this example, you're putting in, let's say, $1,000, right? You're just putting it in, or $100, whatever the number is, and you're adding it into your account. Well, what you're doing is over time, you're purchasing at different points in the market. Sometimes the market's high and you're buying, sometimes the market is low. So for example, if you added that $1,000 and you were acquiring shares, let's say cost $10 per share, okay? And all of a sudden the market dipped, in the next pay period you were buying or putting that same $1,000 in and acquiring those same shares for $5 a share, right? What we have to look at, and what you just did, is you reduced your average share price of your purchase, right? So if you purchased at $10 per share and the next pay period you purchased at $5, what's your average share price? $7.50. All you have to do is get above $7.50 as the market increases, and you're actually making a profit. You don't even have to get back to the $10 share price that you started with. So the whole basis behind dollar cost averaging is over time you're acquiring shares at different points of the market, and by doing that, over time your average share price decreases, which allows you to have acquired more shares during that same time period, so when the market goes up, you own more shares and you catch more upside. It's a huge advantage, and it's underutilized and it's misunderstood in so many ways. It's human nature that when things get volatile, we want to stop, or we want to step back from adding money, and that's the biggest opportunity. So Warren Buffett has a very famous quote, and it's, "Be fearful when others are greedy, and be greedy when others are fearful." You know, typically people are most fearful when we see the most volatility, and that's the biggest opportunity that's out there. So dollar cost averaging, just as a reminder, right, is a strategy that allows you to continue to put money in periodically, right? So if you're adding to a 401k, if you're adding monthly, let's say to a Roth IRA, or even an after-tax account, right? Ultimately, that's allowing you to do these systematic purchases into the account to over time acquire more shares by reducing that average share price, so when the market goes up, you'll see bigger gains, right? A lot of clients come to us and they say, well, Tyler, what do we do if we're retired or going to be retiring and we can't add money like we used to, right? That's a common question, and it's a really good, appropriate question, right? We've added to a 401k for the last 30, 40 years, and now we're to a point where we retire, right? And we just don't have that paycheck anymore, right? You need to utilize your assets to make contributions for you, and that's key, right? You can look for investments that generate a form of yield, right? Yield by definition is the amount of income that is generated without selling anything. Ultimately, by taking that yield, or in this example, we'll use a dividend. Let's say a company that you are purchasing into, right, pays a dividend every quarter, right? Well, that's a dividend that's paying on the shares that you own. You didn't have to make that contribution. So if you're at a point where you don't need to take that income out or that dividend out to live off of, you reinvest it. And now you're dollar cost averaging, and you may have heard the term the rich get richer, right? Or let your money make you money. That's exactly what it's doing. The money is making contributions on your behalf, and instead of doing it every pay period with the dividend in that example, they're just doing it quarterly. But they're still acquiring shares, they're still buying at different points of the market, and ultimately over time they'll own more shares, which equals more dividends, which equals more shares, and it increases the power of the dollar cost averaging that they have. So dollar cost averaging is a great tool to utilize during volatile time periods. It's a great tool to utilize to increase net worth over time. And then number three, when we look at it, Dollar cost averaging is a tool that you can just set in the background and just continue to contribute to, right? The whole advantage is ultimately acquiring as many shares as you can, reducing that share price, and then seeing the biggest gain over a longer period of time.